I followed Lemonade pretty closely since the company's IPO. The stock has largely taken a beating as the business has struggled to generate underwriting profit with its insurance operations. We saw a great result, however, when it reported in the fourth quarter. There's really good momentum. However, everything isn't perfect with the business, and there are three things in particular that I think investors really need to know about Lemonade before buying a single share. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, please go to our special link. It's fool.com/unscripted. Check out that special link. Motley Fool is going to give you its 10 best stocks to buy right now. Please be sure to check it out. An interesting thing happened when Lemonade reported its fourth quarter results. The first thing was the results looked relatively good. However, the stock absolutely plummeted after those results came out. It released the results the morning of the 28th before trading started. Since then, the stock is down more than 25%. Let's take a look at the numbers and talk about the first thing that investors need to know, and that is that the general trend is really favorable for Lemonade. Now, we know if you follow the company for any length of time, you know that revenue has been growing. In-force premium, the dollars of premiums that are in place from customers for various insurance products, whether it's rental insurance, pet insurance, homeowners, life insurance, auto insurance, that number continues to grow. It increased 20% year over year in the fourth quarter. They've added 12% more customers since they ended the prior year. Those are really great numbers. The premium per customer number also continues to grow. That's because it continues to offer more products, more expensive products too, things like homeowners that are a lot more expensive than renters. Auto insurance, of course, is a higher premium. Customers adding more different lines of insurance as their relationship with Lemonade expands. Now, we're seeing the loss ratio fall. 77% is the best loss ratio the company's reported in a couple of years, really. And it's right on the cusp of 75%, which is the number that the company says is their target, is to try to be 75% and lower gross loss ratio. Now, it's great that the general trend is positive. We'll talk more about that trend. However, this is the second thing I want to talk about, is that the days of high loss ratios may not be over. The trend is positive. We see it's really good in growing customers, growing in-force premium, growing revenue. Their margins are getting better. Like all of those things are better. We're seeing the gross loss ratios come down. However, the days of high gross loss ratios might not be completely over. Management talked about that in the shareholder letter. I want to talk about that for just a second here. So here's a good visual representation. We go back to the third quarter of 2022. So over a year and a half ago, oh boy, 94% gross loss ratio. They gave us a little bit of hope. It was coming down through 2022 and then skyrocketed again. Of course, part of that was due to some catastrophic events, extreme weather events, but the trend starts to get really favorable as we get into the end of 2023, heading into 2024. But here we are 6 pages into the presentation, and it's not the pictures that matter, but the words you really want to focus. The company says, while our target of lower than 75% seems tantalizingly close, we want to caution that we expect continued bumpiness on our way and that we may not have seen the last of the 80s quite yet. I think that's really important to note. The company's saying, and here's the thing, they've been telling us for a while that the trends were going to improve. They gave us hints before in the past when we saw the loss ratios go up, that it was expected that it was going to happen based on data that they had access to. And they told us that we would see by the end of 2023, the numbers were going to start looking more appealing. Here they are again telling us, guess what? Maybe don't quite count on being around that 75% or lower level just yet. We still have work to do. That's the second thing to be aware of. Number one, we see really good trends with more customers spending more money on policies, policy revenue growing. The second thing, be aware that as much as the loss ratio has come down, there is still bumpiness that is going to come. It's really important to be aware of that. Okay, let's talk about the third thing, and that's the financial profile. How much money it has on the balance sheet, company's expectations for cash flows going forward. We're on page 16 of the presentation if you're following along at home. And this is an interesting way they start out. Something noteworthy happened in the second half of 2023. Our total cash levels rose. They ended second quarter with $942 million in cash investments, and ended both the third and fourth quarter with $945 million. Goes on to say this suggests we've been flirting with net cash flow positivity for a couple of quarters now. And they go on to offer a caveat. This isn't our new normal quite yet, though we're not far off either. They're saying that we're going to burn rather than generate cash, but far less than our projected adjusted EBITDA losses would imply. This too is noteworthy. This is particularly noteworthy that the company is saying, essentially, that at the loss ratios that they've been at recently, at their operating expense levels that they've been at recently, with the growth rates, with the expanded dollars that each customer is spending, that the company is right on the cusp of generating positive cash flow. That is a wonderful situation to be in. But management is telling us, but we're not quite there yet. We're going to spend money in 2024. One of the things that we know is where that cash is going to be spent. A couple of years ago, the company, because of spikes in the gross loss ratio, because of pressures on consumers, challenges making sure they were delivering the right kind of growth and that they were underwriting better than they had been, the company said, we're going to pull back a little bit from our customer acquisition spend. It sounds like they're going to start spending money to acquire customers again. One of the things the company is really focused on is trying to leverage existing customers and expand relationships, maximize the long-term value of customers you've already acquired versus spending the money that it costs to acquire a new customer before you're able to turn that customer into a profitable relationship. And the company says, well, we think we're at a point where we want to start spending on customer acquisition. Put all those things together, and I think it makes sense why the market was a little bit spooked. The company said, we think our loss ratios are probably going to go up again. We think we're going to start spending more money to acquire customers again. And investors broadly said, we don't like this news. We're going to sell the news here. And that's what has happened. What do I think about the stock? Looking at where things are with the business, looking forward, their ability to succeed, and investors' chances of making money on Lemonade, the investment. I will say this, as much as I've questioned the company over the past couple of years, really been focused on their ability to deliver high-quality underwriting. Here's the bottom line. By and large, directionally, management has basically done what they said they would do. The company has delivered more or less based on how management said that we should expect it. You think about the loss ratios that the company has achieved, its cash burn, its growth rates. Management has been pretty good about saying, this is what we think is going to happen, and then something really close to that being the end result. To me, that's really important because that means that we have a management team that you can trust. They're still saying they expect that by 2025, the business should be net cash flow positive. 2024 is a year where management wants to make investments in growing the customer base. The balance sheet is strong enough to do that. I think what they're doing is the right strategy. I think it makes sense to do. So you put it all together, and I think Lemonade is actually really attractive right now. Yes, there is certainly risk. The model hasn't completely come up to scale. They're telling us they're going to burn cash this year, mostly on customer acquisition, though, not from their insurance operations. And I think broadly, that's pretty positive. Management has met their promises in the past. I think you combine a trustworthy management team with a business that's generally delivering the results management said that they would deliver, and those results are trending towards growth and moving closer to generating positive cash flow. I think Lemonade is really attractive right now, and it's a stock that I would certainly not shy away from buying today.